Hello and welcome to my latest video where I do a comparison of short selling and securities lending in 5 simple slides. Now let's get to it. I keep hearing people using short selling and securities lending as if they're completely interchangeable, yet they're two very different things. Certainly there's a connection, and I'll explain the key differences in the video and where they're linked. Now, if you've made it this far, then I suggest you keep watching until the end of the video for a special bonus that I think you'll benefit from. First, I'll start with short selling. So, what is it? Well, short selling involves selling an asset that you don't own, a stock or a bond, but it can really be any asset, so gold, currencies, and even digital assets. The idea is to sell it at today's price because you think the price will drop in future. It's a twist on an old phrase, but here you're trying to sell high and buy low. In order to collect the proceeds that you sold it for, though, you need to deliver it to get that cash. And since you don't own it, you have to borrow it from someone that does. You might short sell an asset simply because you expect the price to fall, but most commonly, it's part of a bigger multi-asset trading strategy. And what really matters is that the price has fallen relative to the other assets. So you can make money on the overall trade, even if the price of your short sold asset doesn't fall. But look, that would be going into a distraction from a video, so watch for a future video on that subject. Let's turn to securities lending now. Securities lending involves a temporary transfer of assets from an owner to a borrower. The owner's doing it because they earn a rental fee from the borrower, in the same way that if you rent a house from someone, you pay a monthly rental. And just as when someone rents you their house, well, of course, they still own it. The lender of the stock is still legally entitled to any of the benefits of ownership of that stock while it's on loan. So, for example, if a company pays a normal dividend to a shareholder that's just sitting on it in custody, that shareholder would expect to get it from the company. But in this case, because it's on loan, the shareholder that's lent out their assets would get an equivalent amount in cash from their borrower. Remember in the last slide, I said that for the short seller to get the cash proceeds from their sell high leg of the transaction, they borrow the asset. And so securities lending is where they get it from. Usually, institutional investors are looking to generate rental fees from stocks and bonds that would otherwise just be sitting in their portfolios doing nothing other than hopefully appreciating in value over time. So for traders, that's one use for borrowed stock, to meet short sale obligations so that they can get the cash proceeds. The other reason is that traders sometimes have to give collateral to other firms for other types of trades, and that might include other institutional investors, banks, central counterparties, clearing agents, and more. Now, those entities are usually pretty picky about which collateral they'll accept, and if a trader owes them collateral but doesn't have a kind that the counterparty accepts, it probably makes sense for them to borrow that collateral in order to deliver it and meet their collateral obligations. A third reason is that many firms have regulations that require them to hold very liquid assets, such as government bonds. Regulators want those firms to have some high-quality assets on the balance sheet in the event that there's a market disruption. Then those firms can use these high-quality assets to get funding in the event of a crisis. Here again, the trader can provide lower quality collateral and borrow and hold on to the higher quality assets to satisfy their regulatory needs. Let's have a quick look at the borrowing and lending process. There are 4 different entities typically involved in a transaction, and even more if you include the plumbing of how the assets move from points A to B. But that's too much detail for what we're looking at today. In this diagram, we'll go from right to left. Institutional investors, such as mutual funds and pension funds, will delegate lending authority to an intermediary, often, but not always, their custodian bank, allowing the custodian to lend assets on their behalf according to pre agreed parameters. Now, although I'm concentrating on institutions today, this also happens where retail investors use the fully paid lending programs of their brokers. When a hedge fund wants to short a stock, they're required in most developed markets to make sure there are stocks available to borrow before they can do a short sale. Well, that makes sense because it reduces market risk. The hedge fund asks an investment bank to see if these stocks are available to borrow anywhere. The investment bank acting in this role can be called a prime broker, and you may have heard that term used. They really act as the hedge fund's intermediary in the borrowing process. If the prime broker can find assets available, they let the hedge fund know. The hedge fund and the prime broker record the details of why they thought the shares were available in case a regulator wants to check in future. At that point, the hedge fund is free to place the short sale order in the market. After having successfully executed a short sale, the prime broker will organize the borrowing of the stock using the hedge fund assets to provide collateral to the lender and getting the stock from that lender. Once the stock is received, the hedge fund is free to deliver the stock to whomever they sold it to and receive their cash proceeds. Now to the crux of the issue. Does all short selling need securities lending and vice versa? Hopefully, you can see that short selling and securities lending are different and what the relationship between the two is. I want to bring out a few points here that I hope will be interesting for you. Now, as I previously said, would-be short sellers legally have to locate the availability of stocks before they can do a trade. Now, they're constantly locating stock, even if they don't have any intention of executing a trade anytime soon. Remember, a trader will be looking at many potential trades, and eventual execution of those trades depends on numerous variables, not just the availability of the stock to borrow. I'd be surprised if 1 in 10 locates turns into an actual loan someday. Now, day traders, they go long and short constantly, and if they short a stock after having located it, and then cover it by the end of the day, there is no loan transaction. So, not all short sales need a loan of securities. And as I mentioned earlier in this video, some borrowing activity is to get collateral for other obligations or to hold on to because of the regulatory requirements. So the bottom line is not all short sales require borrows, and not all securities loans are for short sales. I thought it might be helpful to briefly cover the risks for short selling and securities lending. For a short sale to be profitable, it requires a fall in price to achieve that profitability. If you sell high and buy back higher, that's a loss. So you need the stock price to actually go in the direction that you hope it will. Then you have to remember that short selling a stock is not the opposite of buying a stock from a risk point of view. So for example, if you buy a stock at 20, the most you can lose is the price you paid for it, and that requires the company to go completely bust. So you have a limited loss. In this example, a loss of 20. But of course, the stock can go to 50 or 100 or 1,000. In fact, the upside is unlimited. In a short sale, if you're selling at 20 and you're hoping to buy back lower, the lowest it can go is 0, and that requires the company to go bust. But if you short sell at 20 and it goes to 50, 100, or 1,000 or more, well, of course, the potential loss is unlimited. Now, you can always try to close out your trade to limit your losses if the stock price starts going up, but sometimes you have to move fast, as many other people will be trying to do the same thing at the same time. And that will drive up the price further and faster. That's called a short squeeze, and that famously happened earlier this year with GameStop, but has happened many times before. Also, just generally, stock markets go up over time, so if you have a short position or several on your books, you're essentially fighting against the market. And good luck with that. Securities lending has a very different risk profile. The primary risk is that the borrower goes into default the way that Lehman Brothers did in 2008. If a borrower goes bust, then there's likely to be a market disruption that might affect the value of the collateral the lender has and the cost of buying back the loaned assets. There are a lot of moving parts in these transactions, and whenever there's complexity, there's a risk of loss due to operational error. Additionally, there's always a risk of regulatory change, and while it's unlikely to generate retrospective losses or costs, it may have the effect of limiting the viability of the business in future. Finally, some investors are worried about being associated with short sellers and those traders that might abuse the regulations. Look, I'd argue that this risk is overblown. And when dealing with people and firms with longevity and expertise, in my mind, this is not a meaningful risk. Let me summarize this video. Short selling and securities lending are two different but intertwined activities. Short selling is a position-taking trading activity carrying market risk. Short selling relies on being able to borrow stocks, but borrows only occur if a trade is executed and isn't covered intraday. Finally, short selling has a skewed risk profile and, in my opinion, should really only be the domain of experts. Securities lending is a relationship business where the risks largely only come into play if a counterparty defaults. The business is very low risk, and while it generates relatively low fees, on a risk-adjusted basis, it delivers consistent streams of revenue whether markets are rising, falling, or moving sideways. And now, as I promised at the start of the video, it's time for the bonus. Now, for those of you that have made it this far and want to learn more about securities lending, you can get a free primer on securities lending. In under an hour, I give you a great understanding of the securities lending business, covering the structure, breadth, details of the business, and stats. Well, that's it. Thanks for joining me, and I hope you've learned the difference between short selling and securities lending. I look forward to catching you next time.